Hello everyone, welcome to the 14th episode of me learning how to trade using Forex. So in the last video we went through the fundamental analysis course on forex.com and we got up to the economic indicators and announcements lesson. We found out there was six important factors that needs to be considered when looking at the economic indicators and announcements. We finished reading the first one, which is the non-farm payrolls, but we ran out of time, so I started making notes on the other factors, so the consumer price index, central bank meetings, consumer and business sentiment reports, purchasing manager index, and retail and vehicle sales. So let's carry on with the consumer price index section then. So consumer price index. As we've covered, though, central banks don't just have the mandate to maintain employment. They also have to ensure price stability by keeping inflation steady. The chief measure of inflation is a consumer price index. So, consumer price index is the chief measure of inflation. Consumer price index is the chief measure of inflation, which measures the changing prices of a group of consumer goods and services. Which measures the changing prices of a group of consumer goods or services. See, consumer price index takes the average price of a group of consumer goods and services. If these prices rise, CPI goes up. If they fall, it falls. It's the average. Right. There are plenty of other inflation measures, however. These include personal consumption expenditures, the producer price index, import-export prices, wholesale price index. However, note that there are other measures of inflation, such as personal consumption expenditures, the producer price index, import/export prices, and wholesale price index. Each economy has its own CPI figures released by a different body on a different date. Take a look at the economic calendar in your Forex.com demo account to check upcoming reports. Why is it important? CPI measures the prices paid by most consumers, so central banks tend to pay more attention to it than other indices. So, CPI measures the price paid by most consumers. So central banks tend to pay more attention to it than other indices. Most developed countries prefer CPI to be around 1 to 3%. Consumer price index. Most developed countries prefer to be around 1 to 3%. If it comes in much higher or lower than that, a change in monetary price policy may follow. If it becomes higher or lower than that. A change in monetary policy may follow. Central bank meetings. As we've seen, most traders follow economic figures so they can anticipate what a central bank might do next. So it only makes sense that we pay attention to what happens when they actually meet and make decisions. So most traders follow economic figures so that they can anticipate what a central bank might do next. So it only makes sense that we pay attention to what happens when they actually meet and make decisions. So it only makes sense that we pay attention to when they actually meet and make decisions. Each central bank will have its own regular meetings. For example, the Federal Open Market Committee, which is in charge of setting monetary policy for the Federal Reserve, usually meets 8 times a year. So each central bank will have its own regular meetings. Why are they important? Oh, so that means the Bank of England will have its own regular meeting schedule then, basically. Why are they important? Traders will watch for any announcements from each meetings. Traders will watch for any announcements from each meetings, such as rate hikes or cuts, forward guidance on policy, on future policy, or any other new monetary measures, such as quantitative easing. Often, the minutes from a meeting will be released shortly afterwards. This can provide crucial insight into whether key central bank personnel are hawkish or dovish. Often the minutes from a meeting will be released shortly afterwards. This can provide crucial signs whether key central bank personnel are hawkish or dovish. Right, okay. Consumer and business sentiment reports. Multiple organizations are constantly surveying consumers and business leaders to create sentiment reports. Surveying business sentiment reports. So, multiple organizations are constantly surveying consumer and business leaders to create sentiment reports. Whilst the number of reports they produce is staggering, they all play their part in shaping the market's expectations for the future. Why are they important? An economy needs businesses and consumers to spend in order to thrive. If businesses and consumers are feeling apprehensive about the economy, their spending tends to be lower, which may impact growth, employment and inflation down the line. As such, these reports tend to be leading indicators. While unemployment and inflation figures are reported on past quarters, sentiment reports can give you an insight into what's going to happen next. Right, okay, so tend to be leading indicators. Whilst employment are reported on past quarters, sentiment report can give you insight on what's going to happen next. So Met reports could actually gives an insight into what happens into the future. Purchasing Manager Index. Purchasing Manager Index measures the prevailing direction of economic trends in a given industry. Measures the prevailing direction of economic trends in a given industry. So measures the prevailing direction of economic trends in a given industry according to the view of its purchasing managers. According to the view of its purchasing managers. According to the view of its purchasing managers. Who are the purchasing managers? They are used as an indicator of the overall health of a sector. Used as an indicator on the overall health of a sector. Like price indices, there are typically multiple different PMIs released for any given economy. A PMI figure of above 50 indicates that managers believe that the business is performing better in the current month than the previous one. So PMI above 50 indicates that managers believe that their business is performing better than in the current month. Than the previous month. If it's below 50, if PMI is less than 50, indicates it's performing worse. The managers have seen less activity than in last year. The managers have seen less activity and than the last. If it is at 50, then the current month is on par with the previous one, because 50 indicates the current month is on par with the previous one. Why they're important? PMIs are used to get a quick on-the-ground assessment of how the sector is performing from the people working within it. How the sector from the people working within it. If a key sector in the country is stalling, then the economy may soon follow. On the other hand, if it is thriving, growth could be on the horizon. Retail and vehicle sales. Retail and vehicle sales are two indicators that measure demand for finished goods and demand within the motor industry respectively. Why these two specific industry though? Retail sales. Two indicators which measures demand for finished good and demand within the motor industry. Why are they important? As we've seen, economies run on consumer spending. Retail and vehicle sales offer a direct measurement of spending, informing traders whether consumption is trending up or down. Retail sales figures give a much broader view of spending and are typically compiled by the government each month. whilst narrower, vehicle sales can be a little bit more expedient, as they are released by businesses themselves. Many traders believe that vehicle sales can offer an insight into general spending, so we'll use them as a leading indicator for the retail figures. While narrower, vehicles can be more expedient. What does expedient mean? Convenient and practical, although possibly improper or immoral. Convenient and practical, so it's more convenient. Right, okay. I think we finished this course. Yeah, we have. Okay, so fundamental analysis is done. What's next? Fundamental analysis. Techniques of successful traders. I think we've just done this one. Economic, yeah. Techniques of successful traders. Let's go. I should probably create a new column, right? Yep. So, layouts, below, techniques of successful traders. Date is 14/01/2024. How to develop a trading plan. A comprehensive trading plan is crucial to successful trading. Without one, you won't have a strategy to guide you or the means to measure your success. So, comprehensive plan is crucial to why a trading plan is important. In short, the most successful traders have a plan. You can't guarantee that you'll always be able to beat the market, but a plan can help set the groundwork for successful trading. With one in place and written down, you'll find it much easier to remain focused on your trading objectives. When the markets are at their most stressful, you don't want to have to rely on judgment. A plan tells you precisely what to do so you can maintain discipline and consistency while keeping losses in check. Tip: a plan is useless unless it is put into action. Many make the mistake of investing a lot of time into creating a strategy but then discarding it when they start trading the markets. So, when you make a plan, you need to follow it. How to build a trading plan. Evaluate yourself. To build a trading plan, you first of all need to take a step back and evaluate your own market expertise, goals and weaknesses. After all, you want your plan to be as tailored to you as possible. So evaluate yourself. Start by assessing your knowledge of the market so you can ensure that I don't get out of depth. If you're a total beginner, for example, then advanced option strategies might not be a great place to start. It is also a good idea to identify which asset classes you're most comfortable with and consider picking a handful of markets to focus on at the outset. As you grow in confidence, you can always come back and tweak your plan. So, I feel like we read this before, but I'll still write this down anyway. So, expertise. Goals. Expertise, assessing your knowledge of markets. Identify which asset classes you are comfortable with. Goals. Why are you trading? If the answer is just to make money, then you may not have thought this through enough. Perhaps you want to get a little extra for retirement, start a new career, or free up time to spend with friends and family. Whatever your end goal is, make sure that your plan is made with your motivation in mind. One of the best ways to do this is to start your end goal and work backwards. Consider where you want to be in 10 years and set 10 annual milestones that will get you there. Set goals, I guess. Strengths and weaknesses. Strengths and weaknesses. You'll want your trading plan to play to your strengths and mitigate your weaknesses. For example, you might need to constantly watch your open positions, which can be tricky if you're holding trades overnight. You could address this weakness by sticking to day trading or using notifications and alerts to keep track of trades without always watching your monitor. You'll learn more about your strengths and weaknesses as you progress, so make sure to revisit and edit your plan periodically. Want the trading plan to play to your strength and mitigate weaknesses. Ensure revisit regularly to edit. Choose your trading style. Choose trading style. Now you have laid out your expertise, goals, strengths and weaknesses, you should be able to identify which style of trading suits you best. If you're targeting long-term returns, I don't want to dedicate too much time each day on opening and closing positions, for example. Positional swing trading may suit you well, or if you're planning on trading full-time but want to avoid paying overnight funding, you could consider day trading. Want to learn more about trading styles? Start the strategies and risk course. Okay. Building a strategy. Your strategy should include how you find opportunities. Yeah, we've definitely read this. Finding opportunities. So, as covered in the last two courses, most traders often find these opportunities in technical fundamental analysis or a mixture of the two. Now you know how each option works, weigh up your preferred method of finding new positions. Using fundamental analysis. Risk and reward. Determine your risk tolerance can be tricky for anyone. A solid starting point is to consider how much you can lose in total, remembering that liquidization can and does happen if you don't maintain your full margin requirements. Consider how much you can lose in total. Successful traders may not necessarily open more winning positions than losing ones. Instead, they manage losing trades to ensure that winning ones keep them profitable. Timing. Timing can be everything when trading, as well as ensuring that your chosen markets are open when you're planning on trading. It's a good idea to research when they might be at the most volatile. Volatility often peaks towards the beginning or end of session, as well as when reports or news are released. Ensure your markets are open when trading. Research when they might be at the most volatile. Often during the beginning and end. Often during the beginning, ends, and when reports or news is released. At this point, you might also want to choose your chart timeframes. Choose your chart timeframes. Ideally, you don't want to switch timeframes at random. Consider picking a base chart that you use for your first and more foremost, with two others you can refer to when you want to confirm trends. By selecting a base chart and two others which can be used when you want to confirm trends. Take care of the details. The final step when creating a successful trading plan is to add as much detail as possible. Add as much detail as possible. Lay out precisely which markets you're going to trade and when. Decide how much capital to allocate to each position, as well as where to set stops and limits. Lay out precisely which market you're going trade and when. How much capital to allocate to each position, as well as where to set stops and limits. Capital to trade as well as where to set stops and limits. A checklist can be a useful reminder to use in practice. It helps you set your chosen path and reinforces why you're trading. Ideally, your checklist should cover every step of finding opportunities, opening trades, and managing positions. Checklist could be used as a reminder in practice. Checklist which covers every step. Confirm the longer term trend, check the calendar for major news announcements, identify a specific entry trigger, ensure the risk-reward ratio is appropriate, and place trade. Right, okay, Finally, consider keeping a trading diary. This enables you to see precisely how your trading journey is progressing, so you can identify your strengths and weaknesses, eliminate mistakes, and build on success. Much like these videos that I'm doing. So, confirm the longer term trend. So, confirm could include confirm check for calendar for major news and announcements. Identify a specific entry trigger. Ensure the risk/reward ratio is appropriate and place trade. Finally, consider keeping trading diary. Also, keep a trading diary. This enables you to see precisely how your trading journey is progressing, so you can identify strengths and weaknesses, eliminate mistakes and build on successes. Also keep a trading diary. Your trading diary can be as detailed as you want, but at a minimum it should cover reasoning behind each trade, profit targets and maximum loss, entry and exit levels, emotions as you enter and exited the position. A trading diary can also help you decide whether you are trading consistently. It can ensure that you are consistent with your strategy. Then you can see where it's going wrong and tweak it accordingly. Consistently, can see where it's going and tweak it accordingly. We're trading consistently. Tracking your consistency, which should at least cover.
Throughout your Forex trading journey, you will have both ups and downs. It's easy to get distracted by the different trading methods out there, so you need to make sure you have a trading plan that you stick to, whatever the circumstances. Here are our 5 golden rules for building a successful trading plan. Golden rule number 1 is to keep it simple. You don't need to be a quant, creating complicated algorithms or game theory scenarios for every single trade you place. Simply find a strategy that is straightforward and easy to execute for your particular risk tolerance and trading objectives. Secondly, do your research. By watching this video, you're moving in the right direction. But the more you research the markets and news flow, the more fluent you will become in understanding what makes currencies move, increasing your chances of identifying trading opportunities. Third, be realistic with your goals. Simply stating that you want to double or triple your initial deposit is not enough. Learn to understand risk and reward per trade. Successful traders often have a profit and loss goal on entering each trade. Also, make sure you manage your risk. Work out how much risk is acceptable to you and take it from there. Ensure you're aware of the risk management tools available to you on your platform. Finally, keep a trading journal. It may seem silly, but your emotions affect your trading decisions, sometimes in a negative way. If you write down your trades, why you placed them, and the eventual outcome, you can learn from your experiences. You'll find all the research and articles you need at forex.com.
Cool. Alright, so test your knowledge. Why is it important to have a trading plan? To ensure you're trading consistently, to help you stay focused on your objectives, to guide you when trading stressful, all of the above. You should check your plan before you open each true or false true. What shouldn't you note down in your trading diary? The weather. Alright, so optimizing your trade entry. What are we on? Okay, good. We've got some time left. So, getting your entries right is crucial to successful trading. In this lesson, we'll cover 3 techniques to improve your timing as you enter your positions. Getting your entries right. So, getting entries right is crucial for successful trading. Once you have a trading plan in place, optimizing how you open positions is an excellent way of growing profits and limiting losses. You can consistently trade at the right level and in the right direction, then you should see your percentage of winning positions grow. There are multiple different methods to optimize your entries. Here we're going to introduce you to 3. Spotting breakouts, using time frames, and taking a broader view. Breakouts. 3 methods of optimizing entries. Breakouts. As we learned in the technical analysis course, the trend is your friend. Trend is your friend. By using pullbacks and breakouts, you can ensure that you're getting it in at the beginning of uptrends and downtrends instead of the peak. By using pullbacks and breakouts, you can ensure you're getting in at the beginning of uptrends, downtrends, instead of at the peak. How? By using the fact that market movement is rarely linear. Even strong uptrends will contain minor downward moves, while strong downtrends will still feature small bull runs. These small counter trends are called pullbacks and will often tend to form at support and resistance levels. So because market movements are rarely linear, strong trends will often contain small trends in the other direction. These small counter trends are called pullbacks and will tend to perform at support and resistance levels. Will tend to form at support. Breakouts occur when a market breaks through one of these levels. So, boop. Breakouts occur when a market breaks through one of these. When a market breaks through one of these levels. When you see a breakout, which is, so it goes like that, drops down, and then you see that, and then you just, if it starts going upwards, then you should start entry in here. And it's a sign when you see a breakout, it's a sign that the original trend is reforming. This makes them a useful place to enter a trade by opening a buy or sell position once the market moves beyond the support or resistance line. As a general rule of thumb, the more times support or resistance level is tested, the stronger the breakout that follows once it is broken. Watching for fake outs. The pullback, you start entry here, and it goes back down. Just because the market has broken a support or resistance level, though, it doesn't necessarily mean that breakout will follow. Sometimes the market will pull back once again in a fake out. Because of this, proper management, risk managers are a must when trading breakouts. By placing a stop just below the breakout level, you can automatically close your position if a fake out is confirmed. Watch for fake outs. which is when the market will pull back once again after a breakout. Testing across time frames. As we've discovered in the last lesson, jumping from between lots of different chart time frames isn't necessarily a good strategy for trading. However, using one or two additional time frames to confirm the trends that you found can help increase your probability of profitable trades. So, testing across time frames. Using one or two additional time frames to confirm the trends. Say that using a 4-hour chart to look for opportunities in the AUD USD, and you've identified a pullback that you believe might lead to a significant breakout. So is that here? You could double check the broader trend by taking a look at the daily chart. Confirm, using a 4-hour chart, so we're looking at this one. Confirm how long the bear run or the bull or bear run has lasted. You can also see whether the market has hit any support resistance level multiple times in its wider trend. So that alternatively you might want to check a 10-minute chart to see what is happening on a macro level, so you can check whether buyers or sellers are in charge within the current trading period. Taking a broader view. Okay. Taking a broader view. Well, our final tip for optimizing your entries is to make sure you are aware of the broader conditions of the market you're trading. Be aware of the broader conditions of the market you're trading. This includes the major trend that the market is in, and whether that trend is sustained or just forming. Includes the major trend the market is in. Whether that trend is sustained or just forming, as well as a few fundamental factors surrounding it, You could check whether any economic releases might cause volatility in the short term, for example. By taking a more holistic approach, characterized by the belief that parts of something are interconnected and can be explained only by reference to the whole. By taking a more holistic approach, you can identify potential risks to your position that you might otherwise miss. So taking a look at the whole picture, basically, instead of just focusing on one thing. You can also outline the market conditions that suit your style of trading best. Note down the conditions for each position in your trading diary and review it often to see whether any patterns emerge. You might find that you have more success in markets that are range bound, in swings, or experience low volatility, which can give you a useful boost. Can also note down, or can also outline the market conditions which suit your style of trading, best. Note down the conditions for each position in your trading diary and review it often to see whether any patterns emerge. Note down the conditions for each position in your trading diary. You see if any pattern. You might find that you have more success you might have more success in markets that are range bound in swings or experiencing low volatility, which can give you a useful boost. Market conditions. There are lots of different market conditions that you might want to cover in Trade Diary. These can include longer term trend, central bank posture, upcoming events, or more. Which can include longer term trend, central bank posture, upcoming events. Can also outline the market conditions which suit your style of trading the best. Which can include longer term trends. So whether I'm good at trading upward trends or downward trends, that sort of thing maybe. Yeah. Okay. Risk versus rewards. I think we're going to leave this video here, guys. Thank you for watching. Yeah, that was a really useful lesson. So yeah, I'll see you in the next video about the techniques of successful traders in the risk versus rewards lesson. So yeah, see you later.